Everyone says Pennsylvania is the retirement tax haven and New Jersey will bleed you dry. But in 2026, that story most people believe is about to flip for a huge chunk of retirees. And if you're planning your next 20 years right now, getting this wrong could cost you six figures. Not because of what you already know, because of 6 hidden traps and secret plays that almost nobody is talking about. Now, I need to be upfront with you. I've spent hundreds of hours digging through state tax codes, property records, and real retirement case studies for this one. Because the stuff I found is the kind of thing that makes you want to call your parents and say, "Don't sign anything yet." And today I'm going to walk you through the 6 things that actually decide whether Pennsylvania or New Jersey is the smarter move. Things your neighbor, your brother-in-law, and most YouTube videos have never mentioned. But before we get to any of that, I need to show you why one single dollar, literally $1, can trigger a $6,000 tax bill in New Jersey. And no, that is not a typo. Let's start with the number that breaks people's brains. New Jersey gives retirees an income exclusion. If your household income stays under a certain threshold, your retirement money, pensions, IRAs, the works, comes out tax-free. Sounds generous. And it is, until it isn't. Here's the part that nobody frames correctly. This exclusion doesn't phase out gradually. Think of it like a light switch, not a dimmer. You're standing on solid ground at $149,999. Your state income tax bill is close to zero. You take one step forward, $1 forward, $150,001. And New Jersey hands you a bill for roughly $6,000. Let me say that again because it sounds like it can't possibly be real. You earn one extra dollar, just one, and the state sends you a tax bill for $6,000. That is not a gradual increase. That is not a phase-in. That is a cliff with no guardrail and no warning sign. Now, why should that terrify you more than any other tax rule? Because of what the math actually looks like at that edge. If earning one additional dollar costs you $6,000 in new taxes, your effective marginal tax rate, the real rate on that $1, is 600,000%. Think about that. You wouldn't accept a 6% fee on a bank transfer. Imagine 600,000% on $1. I've never seen a number like that in any other state tax code in the country. And here's what makes it even more dangerous. It's not just your salary that counts toward that threshold. It's everything. Your pension, your Social Security, your IRA withdrawals, your dividends, that rental check from the duplex you forgot about. If the total crosses $150,000, every dollar of your retirement income becomes fully taxable. Not just the dollar that pushed you over. All of it. Let me show you how this destroys someone who doesn't see it coming. Couple in their early 60s. Combined pension and Social Security. $148,000. Comfortable. Tax-free in New Jersey. Then the husband cashes out a small CD, $3,000, to pay for a new HVAC system. Seems harmless. Total income, $151,000. That CD didn't cost $3,000. Cost $9,000. 3 for the HVAC, 6 for the tax bill they never saw coming. One trip to the bank and their entire tax picture changed. Most people don't even know this cliff exists. They pick New Jersey because the shore is nice and the grandkids are close. January hits, the bill shows up, and they have no idea what happened. So you're thinking, fine, I'll just pick Pennsylvania and dodge the whole thing. 0 state income tax on retirement money. Clean, simple, safe. And honestly, for most people that's the right instinct. But here's what nobody talks about. Even if you pick Pennsylvania to dodge that cliff, you might walk right into a different trap, and this one has nothing to do with your income. It depends entirely on your zip code. Here's what I mean. Every retirement video on the internet says the same thing. Pennsylvania equals 0 tax on retirement income. And technically, that's true. The state of Pennsylvania will not tax your pension, will not tax your 401k, will not tax your Social Security. But here's the part they always leave out. The state is not the only government that gets to tax you. If your address has a Philadelphia zip code, you're inside city limits. And Philadelphia runs its own tax system, completely independent of the state. They have something called the Philadelphia wage tax, about 3.44% for residents. Now, that only hits earned income, not pensions or 401k withdrawals. So if you're fully retired with nothing but passive income, you're fine. But how many retirees today actually stop working completely? Think about it. Your neighbor consults 2 days a week. Your sister freelances from home. Your buddy drives for a rideshare app on weekends. Millions of retirees have some kind of side income. And if you're one of them, every dollar of that earned income gets hit with the city wage tax. And it gets worse. Philadelphia also has something called the BIRT, the Business Income and Receipts Tax. If you're doing any kind of self-employment inside city limits, even selling things online from your living room, you're paying BIRT on top of the wage tax. We're talking potentially thousands of dollars a year that a retiree in Bucks County, literally 20 minutes up the highway, would never pay. Same state, same retirement, completely different tax bill. Let me put a real number on this so it hits home. Say you're a retired consultant pulling in $30,000 a year on the side. In Doylestown, Bucks County, your Pennsylvania state tax on that is about $920. That's it. Flat 3.07%. Now move that same income inside Philadelphia city limits. You're paying that $920 plus another $1,000 in wage tax, plus BIRT fees on top. You could be staring at $2,500 or more in city-level taxes that nobody mentioned when they told you Pennsylvania was a retirement paradise. 2 retirees, same state, same income. One pays $900, the other pays $2,500. The only difference is a zip code, and nobody warns you about this in the standard PA versus NJ comparison. So here's where we stand. Pennsylvania has a hidden zip code trap. New Jersey has a $150,000 cliff. Feels like there's no winning, right? But actually, and this is the part that surprised me the most when I was researching this, New Jersey has a secret combination that most retirement channels don't even know exists, because most of them only ever talk about one half of it. You've probably heard of Stay NJ. Starting in 2026, if you're 65 or older and your household income is under $500,000, New Jersey gives you a tax credit worth 50% of your property tax bill, capped at $6,500. That's the headline. That's what every channel covers and moves on. But there's a second program hiding in plain sight. It's called the Senior Freeze. Official name, Property Tax Reimbursement Program. Think of it like a lock on your property tax bill. Once you qualify, the state freezes your tax amount at whatever it was that year. Your neighbor's taxes go up. Yours don't. They're locked. Year after year after year. Now here's where it gets powerful. What happens if you combine both? Senior Freeze plus Stay NJ. On the same property. At the same time. Let me walk you through what that actually looks like because the numbers are wild. Year 1, 2026. Your property tax bill is $13,000. Senior Freeze locks it right there. Stay NJ hands you a $6,500 credit. Out of pocket? $6,500. Now fast forward 5 years. 2031. Your neighbor's taxes have climbed to $16,000 because that's what property taxes do, they climb. But yours? Still frozen at $13,000. Stay NJ still cuts it in half. You're still paying $6,500. Your neighbor is paying $16,000. That's nearly a $10,000 gap between your house and the one next door. Same street. Same school district, same town. Meanwhile, Pennsylvania has a property tax rebate program. Sounds promising, right? But it's only for households earning under $45,000. If you're a middle-class retiree, and if you're watching this video, you probably are, you don't qualify for anything meaningful. A couple $100, maybe. That's it. So New Jersey has a genuine secret weapon on property taxes. But here's the problem. What good is saving thousands on property tax if that $150,000 income cliff wipes out those savings and then some? You need a way to dodge the cliff first. And that's exactly what the smartest retirees figured out. Except they don't do it when they retire. They start 5 years before. Most people pick their state after they retire. They look at their income, look at the tax rules, and go wherever the numbers land. The smart ones flip that entire sequence. They start reshaping their taxable income years before retirement, so that when they finally move, the numbers land exactly where they want them. The tool they use is called a Roth Conversion ladder. And if you've never heard of it, think of it this way. Right now, your retirement money is sitting in a traditional 401k or IRA. It's like water behind a dam. When you open the gates in retirement and start pulling money out, every dollar that flows through counts as taxable income. That's the water that pushes you over New Jersey's cliff. But what if you could reroute some of that water into a different channel? One that the state can't see? That's what a Roth conversion does. You move chunks of money from your traditional 401k into a Roth IRA before you retire. You pay the tax now while you're still working while you can absorb it. And then in retirement, every dollar you pull from the Roth comes out tax-free. It doesn't count toward New Jersey's income threshold. It doesn't push you toward the cliff. As far as the state is concerned, that money is invisible. Now let me show you why this matters with real numbers, because the savings are enormous. Couple in their late 50s. Combined income projections in retirement from 401k and pension. $200,000 a year. Way over the cliff. Without this strategy, they're looking at $6,000 a year in New Jersey income tax. Every single year. For decades. But 5 years before retirement, they start converting $50,000 to $60,000 a year. From their traditional 401k into a Roth. Yes, they pay federal tax on each conversion, that's the cost. But they're doing it strategically, staying within their current tax bracket. Spreading the pain over 5 years instead of one big hit. When they finally retire at 65, their taxable income from traditional accounts drops to about $140,000. The rest comes from Roth withdrawals, tax-free, invisible, below the cliff. $6,000 a year saved. Over 20 years, that's $120,000. From a decision they made half a decade before they ever packed a single box. Now, I want to be straight with you. This is not a magic bullet. Roth conversions trigger real taxes in the year you convert. You need to calculate your current bracket against your projected retirement bracket and find the sweet spot. This is a conversation for your CPA, not your brother-in-law at Thanksgiving. But for retirees who are over the cliff by $10,000 or $20,000 or $30,000, this is the single most powerful lever you can pull. And almost nobody in the PA versus NJ conversation ever brings it up. So at this point, you can engineer your income to dodge the cliff. You can stack New Jersey's secret combo to crush property taxes. Pennsylvania has zero income tax on retirement money. Both states have real advantages. So which one do you pick? What if the answer is neither? Or rather, what if the answer is both? This is the part that changes everything. The smartest retirees I've researched don't pick one state and hope for the best. They pick both. Pennsylvania first, then New Jersey. And the timing is what makes the whole thing work. Here's why. Between age 60 and 65, you have a window where Pennsylvania gives you something New Jersey can't. Completely tax-free retirement withdrawals with no income threshold. No cliff, no asterisks. But you're not old enough for stay-in-J. You're not old enough for senior freeze. New Jersey's best weapons aren't available to you yet. So phase 1, you retire at 60. You move to Pennsylvania, Bucks County, Montgomery County, wherever suits your life. For 5 years, you pull money from your 401k, your IRA, your pension. Pennsylvania taxes none of it. Zero. You're living on tax-free income while your Roth conversion strategy from the previous years continues to compound in the background. During this phase, you're also selling your existing home, settling into a more affordable property, and banking the equity difference. Then you turn 65, and everything shifts. Phase 2, you move to New Jersey. The day you arrive, Stay-in-J kicks in. 50% off your property taxes. Senior freeze locks in your assessment from year 1 so your bill never rises. Your Roth distributions keep your taxable income safely below the cliff. And here's the move that makes this entire strategy worth it. When you eventually pass away, New Jersey charges zero inheritance tax to your children. Zero. Not a dollar. Pennsylvania would have taken 4.5% of everything you left behind. Let me run the full projection so you can see the payoff. 5 years in Pennsylvania, you save roughly $30,000 in income taxes that New Jersey would have charged during those years, when you didn't yet qualify for their senior programs. 15 years in New Jersey, you save $60,000 to $80,000 in property taxes through the double stack, plus Plus, you save your family $100,000 or more in inheritance taxes depending on your estate size. Total advantage over 20 years compared to staying in one state, $120,000 to $180,000. The cost? 2 moves. Call it $40,000 total in moving expenses and closing costs. You're spending $40,000 to save $150,000. That's a 275% return on a moving truck. Try getting that from your brokerage account. Now, before you start packing boxes and drawing up timelines, there's one more thing you absolutely need to hear. Because everything I just described only works if you do it right. And both states have people, professional investigators, whose entire job is to catch retirees who don't actually live where they claim to live. Here's what most people don't realize. New Jersey's Division of Taxation is one of the most aggressive in the country. When it comes to something called a domicile audit, your domicile is just a legal word for where you actually, physically live. Where you sleep, where you eat, where your life happens. And New Jersey doesn't just take your word for it when you say you live somewhere else. They investigate, like detectives. Want to know what they look at? Your E-ZPass records. Which toll plazas are you hitting every morning? They check your Amazon delivery history. Where are all your packages going? They pull your voter registration, your bank statements. They look at your gym membership, your doctor's office, even your vet, because if your dog sees a vet in Cherry Hill every month, but you claim you live in Doylestown, somebody's going to notice. I read through a case that should keep every retiree up at night. A couple claimed Pennsylvania residency for 3 years while actually spending most of their time at a condo in New Jersey. The state audited them. The evidence was overwhelming: cell phone tower pings, credit card transactions, even church attendance records. The result? Over $40,000 in back taxes, plus penalties, plus interest. Years of supposed savings, gone in a single envelope from Trenton. So does that mean the two-phase strategy is risky? No. And here's the critical difference. If you actually move, genuinely, physically relocate your life, you're completely fine. Change your driver's license. Register to vote. File your taxes from your new address. See doctors in your new state. Get your E-ZPass updated. Live there for real. The difference between strategy and fraud is simple. Intent and paperwork. Move for real and you're in the clear. The people who get caught are the ones who try to have it both ways. Claiming Pennsylvania residency while sleeping in New Jersey 4 nights a week. That's not strategy. That's a coin flip with a $40,000 downside. So here's where all of this lands. The $150,000 income trap is real. It's a cliff, not a slope, and crossing it by a single dollar can cost you $6,000 a year for the rest of your life. But that cliff is not the whole story. Not even close. What separates the people who lose 6 figures from the people who save 6 figures comes down to knowing these 6 plays. The income cliff and how to stay on the right side of it. The Philadelphia zip code trap that turns Pennsylvania's tax haven into a tax headache. The senior freeze and stay NJ double stack that most channels don't even know you can combine. The Roth Conversion ladder that lets you redesign your taxable income years before you retire. The two-phase strategy, Pennsylvania first, then New Jersey, that captures the best of both worlds at exactly the right time. And the domicile rules that let you execute all of it cleanly, legally, and without ever looking over your shoulder. Miss even one of those and you could be writing checks to Trenton or Harrisburg that you never needed to write. Get them all right and you could keep $150,000 or more over a 20-year retirement. If you're planning retirement anywhere in the Philadelphia area, and you want someone to walk through your specific numbers, your income, your timeline, your estate, your family situation, book a call with me using the link below. We'll map out both states, both phases, and every program you qualify for. And if you're not quite ready for that, grab my free PA versus NJ retirement comparison guide using the link in the description. It has every number from this video plus a worksheet you can fill in at your kitchen table tonight. Now, I covered the big strategy today, the moves that save 6 figures. But what about the day-to-day stuff? Groceries, gas, home insurance, utilities, all the things that quietly drain your checking account every single month. I've got another video that breaks all of that down line by line. You can watch it right here. Thanks for watching. I'll see you in the next one.